All right, Antti, are you ready?
I'm ready.
All right. 3, 2, 1, let's jam. Hello and welcome, everyone. I'm Corey Hofstein, and this is Flirting with Models, the podcast that pulls back the curtain to discover the human factor behind the quantitative strategy.
Corey Hofstein is the co-founder and chief investment officer of Newfound Research. Due to industry regulations, he will not discuss any of Newfound Research's funds on this podcast. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinion of Newfound Research. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Newfound Research may maintain positions in securities discussed in this podcast. For more information, visit thinknewfound.com.
In this episode, I speak with Antti Ilmanen, Principal and Global Co-Head of the Portfolio Solutions Group at AQR Capital Management. Antti has long been one of the most thoughtful voices in the world of expected returns, having written not one, but 2 landmark books on the subject. But in his latest paper series, he returns to the topic with fresh urgency, probing the difference between objective and subjective expectations and asking why even rational models can go so wrong in real time. We explore everything from CAPE ratios and market timing accusations to why equity investors tend to extrapolate while bond investors expect mean reversion. We dig into how behavioral biases, valuation anchors, and structural shifts collide when forming capital market assumptions, and how Antti and the AQR team try to navigate that mess themselves. If you're in the business of long-term forecasting or just curious why markets often act like they've never read the textbooks, this is a conversation you won't want to miss. Please enjoy my conversation with Antti Ilmanen. Antti, welcome back to the show. Great to have you joining me again. This is a rare treat. Actually, listeners won't be able to see this. I never do visual, but you can probably see this, Antti. Right over my shoulder on my shelf are your 2 books. You have Expected Returns and then Investing Amid Low Expected Returns. The first one of which I think is actually signed by you. I got you signed when I saw you at a conference. So this is an exciting time to have you back on, which leads me naturally, though, into my first question, which is, I just pointed out, I've got these 2 books written by you on this topic of expected returns. And you are currently, actually, I didn't realize, mid in the process of publishing a whole series of papers, of which we're going to talk about those that have been already published today. But this is something you've already written about extensively. Can you talk to me a little bit about what motivated you to return to this topic and write something new in this series of papers? What were you hoping to add? What were you hoping to clarify? What's new and groundbreaking here for the readers?
Sure. And you know me, there's not going to be one answer. I'll sort of give 3. And the first one is related to this idea that I very much talked about objective expected returns. Let's define that in a moment. But now I want to talk about what are actual investor expectations, which we mainly read from surveys. And I like the idea of getting expectations straight from the horse's mouth rather than inferring from market prices. And there's actually a story about this is repentance partly for my PhD time shyness. So I got a footnote story of going to Pharma's office 30 plus years ago and telling that I would like to do something with survey data. And Pharma looked smilingly me in the eyes and took a paper, crumpled a ball. I said, "Do you know what I think about expectations data?" He threw that crumpled ball behind his back straight to the waste paper bin. Nothing but net. So that was impressive, but it also discouraged young Antti from pursuing the topic then. I've still been interested and I've been using survey data later. I've tried to encourage others doing that, and I've been really happy to see greater use of survey data. And there's going to be a lot of that in this series. And there are some really interesting results. So second point I want to make is substantively, there will be this contrast sometime where subjective and objective expectations, again, let's discuss, they can be totally opposite. Subjective expectations can be some backwards, I would say, if objectives are somehow right. And lastly, I want to say there's a broader context of me still fighting the battle against rear view mirror and sort of myopically looking at what's been happening recently. I think I had in my second book, I had this summary that if people ask, do you care more about 100 years of paper data or 3 years of your live portfolio experience? The Dr. Spock statistician answer is, of course, the former. And any human's Captain Kirk answer is the latter, of course. And I'm trying to lean people a bit towards the Spock side, even though it's hard. So that's the context.
So let's draw this distinction explicitly at the beginning here, but between what you mean by objective and subjective expected returns, because these are phrases that you use throughout the whole series, and it's really important to get these right. We'll use them in the conversation. So I'm hoping you can start by defining these terms. But one of the things I really loved in the series is you actually mapped these two ideas to different parts of the discounted cash flow model. I thought that was really, at least for me, clever way of understanding how you were thinking about this. And so I was hoping you can lay out the definitions and then for the listeners, map how objective and subjective tied to the different parts of that model.
Yeah. So first, objective, I think I would call it objectively feasible, and objectively feasible now sort of comes from long-run empirical data. What kind of predictors have predicted returns to the right direction on average? And starting yields and market value, low valuations, let's say when you talk of high expected returns, fit the bill. So most academic research and my books have focused on these objective measures. And I think that sort of makes sense. One handicap is that they don't isolate what are the expectations and what are risk premia. So when we think of cheap equity valuations, it could be that it is meager growth expectations or high required equity premium or steep yield curve rising rate expectations or high required term premium. And those can't be isolated. So that's objective now. Subjective is really go to the horse's mouth. Let's survey investors and ask, what are you expecting? And then we can isolate those two parts. So then best read off from some surveys. And of course, there are many different types of surveys. There are different investor groups, and especially retail and institutional investors may have quite different expectations. And I'll comment something on that, I think, as we go. So more generally, the message is that in times like 2000 or 2021, a few years ago, even recently, when market valuations have been very high, we see some evidence that expectations on equity market growth or earnings growth are very, very high. And that's basically meaning that objective expectations are low and subjective expectations are very high. And that contrast, I think, is particularly interesting. And then to make sense of that, as you were asking now in the context of that discounted cash flow model, and I wish others could see me using my hands here, think of just price equals, very simply, expected future cash flows in the numerator discounted by some relevant discount rate in the denominator. And so for academics, the focus on expected returns is in that denominator. It is like whatever cash flows are what they are, those expectations are what they are, and then we are discounting them with a risk-appropriate discount rate, and that gives us the expected return. And that's not the way most people naturally think about. They think about the numerator. They think that if expected cash flows are strong, then we have high expected returns. So irrespective of price, they don't think much about what's priced in the market, what's in the discount rate. They think good news is good news. And that can be, by the way, my focus in the series is on market direction, thinking about the overall, let's say S&P 500, what's a good time and bad time for that. But the same idea goes for countries, US versus non-US, or single stocks, typically growth stocks versus value stocks. So all the stories that I say have got some parallels beyond the market timing story.
Some subjective expectations seem more irrational than others, at least according to your papers. For example, in the papers, to quote you, you call equity analysts' earnings expectations, quote, over-optimistic and over-extrapolative. Can you sort of unpack this view for us? Like maybe talk a little bit about the range of subjective views and survey types.
Yeah. I want to sort of emphasize that equity analyst story because there are, I think, some entertaining parts to that. So over-optimism is basically, it's so common there. So equity analysts in the last 40 years, when we look at their long-term, next 3 to 5 year consensus earnings per share growth expectations, they're always 10 to 20%. And in reality, the baseline is certainly in single digits. So 10 to 20 is a standard. And when we look at how that optimism evolves over time, it tends to be there from 5 years to 3 to 2 to 1. But somewhere in the last few months before earnings announcement date, that over-optimism evaporates. And by the time we get to the earnings announcement date, these analysts are actually slightly pessimistic. So what's going on there? Well, it's analyst incentives. they need access to their CFOs and CEOs, and they need to make those guys happy to get that access. And collectively, they basically make them twice happy. First, by this long-run over-optimism, which is sort of nice to see, but those CEOs don't want that over-optimism on the earnings announcement date because they want to see beatable estimates. So you need this walk-down path towards some pessimism before the date. So it's a very prevalent pattern. There have been some nice academic studies on this, but it really shows that incentives matter, and you can't really take those consensus forecasts sort of without thinking about that over-optimism. I'll ignore that very short-term part that I was just highlighting there. But then when it gets to the other part that I said, over-extrapolation, well, it would be nice if there were just a constant amount of over-optimism, but that hasn't been the case historically. There has been more over-optimism after good times. So there is this rear view mirror mindset also among analysts. After strong 5 years of EPS growth, you'll see double-digit expectations there almost all the time. And after disappointing times, they will expect less. Whereas in reality, there has been actually mean reversion tendencies in those earnings per share growth series when you look at 1 5 year to the next one. So the bottom line then is that they are really bad market timers. And when we later talk about capital market assumptions or so, I say that even though it would make clear logical sense to use yield plus growth, what growth number should we use for equities? Let's take analyst forecast. Well, let's not do that because they are basically inverse market timers. If starting yields are good predictors, then you are adding to that some growth number, which is a bad predictor. You end up having no predictability. Not a good idea to use in CMAs. Maybe last thing I mentioned here. So again, I focus on the overall market, but it was interesting when I looked in the series during writing these papers, when I looked at some variations. So there is some results on analysts being more optimistic on US than non-US. And again, it is rear view mirror driven, but also within US, when I contrasted sort of the market cap weighted expectations versus median stock expectations, mostly they go together, but in sometimes like the dot-com bubble in late 99, and then in the last 7 years, most of the time, you see that there's a big gap. And that's sort of getting to this kind of median average stock versus the Mag 7 or mega caps, which have become these huge darlings, and where the growth expectations and growth reality, of course, recently has been much higher. So again, you can look under the hood and you find some further interesting results that are sort of side stories in my market directional focus.
So that distinction between the median and the market cap makes me think about survey data in particular, and this issue of ultimately what is skin in the game, right? And so my question there is, why not just, when we talk about truly what people's subjective views are, why not extrapolate that from, say, the global market portfolio? If someone says they're wildly bullish in a survey but doesn't actually act on it, are they bullish, right? Or should we actually be trying to extract from the data the aggregate market clearing subjective view? Where do we have this distinction between what people say versus what they do?
Yeah. Well, we only have one market and we have a different investor groups. So we may later get to the institutions versus retail. And I think there are quite big differences there. Yeah, one interesting result seems to be that even, let's say, institutions who on paper act like contrarian, they act in the spirit of these objective expected returns in their capital market assumptions. But when you look at their actual portfolios, they are not all underweighting US, even though that their CMAs say that they should have done it. And they are certainly like counting their blessings that they didn't do that. Logically, that would have been the right thing to do, even though it exposed turned out to be a bad call for the last few years.
So let's talk about that, because you call objective expectations, quote, rationally feasible. And yet objective expectations, as I see you define them in the series, have really been quite wrong for, frankly, my entire career. If I just have to put it out there, I think that I've been operating in a market where the rational expectations have actually been right. So I'm curious, is this a reflection of a large persistent surprises, whether it's inflation or growth, or is this a flaw in how objective expectations are being developed?
Yeah, I'll come to your question, but the broader point I do want to challenge there a little, that investors, we are too greedy and too myopic, sort of recency biased when we are thinking about something working. Like one interesting result, this is, I think, in Zuckerman's book on Jim Simons, is that the Renaissance was right 51% of the time in their trades. So at high frequency, it's 51%. With monthly forecast horizons, we might be talking of 55% or so. I think when we talk about this long run forecast, maybe 67, 2/3 of the time. So 1/3 of the time you're wrong, and that's great. So now when we look at longer histories, and we just happen to have this, the latest one is in the wrong side of that, we just focus on that too much. And I am trying to fight against that mindset. But then to your question, is this fact that they have been like CAPE, especially by the way, like CAPE hasn't been so wrong in Europe or emerging markets or so on, and it certainly was great in 1990s or 2000s, like getting those decades very well. But post-GFC, where you talk of your career then, so it has had this long miss on US equity market especially. And this is what we focus so much on. And so I think you can somehow trace it to some persistent macro surprises that you were highlighting. But more simply, I would say that it's also then persistent valuation changes, that we basically went from post-GFC mildly expensive market, or let's say just fairly valued market. When you look at really long run histories, it wasn't that they were super cheap, they were sort of fairly valued, to going to near all-time highs then in valuations. And that has been the key story that has driven this strong performance of US equities. And we'll surely get back to that. But that type of cause for outperformance is less compelling to me than some other possible ways of having created it. And then I also want to just maybe say that hindsight bias is always so dangerous in these things, that it makes us think of that one realized history as more predictable than it was. And this is actually really quoting someone I sometimes criticize, Nassim Taleb, but I think in his book Fooled by Randomness a long time ago, he really made this point in a very compelling way. And so the hindsight, when we look at that one history and we think that obviously this is what happened, is just a false logic, but very human false logic.
I want to actually stay on that false logic point for a second, because in your paper series, you point out that surveys of subjective equity expectations tend to peak when valuations are at their highest, like in 2000 or 2021, and tend to hit their lows when valuations are at their lowest, say 2008. And people have used that in the past to point out the irrationality of investors, that they're over-optimistic at the peak and they're over-pessimistic at the trough. But in my view, it's almost tautological that investors have to be their most optimistic at the peak and the most pessimistic at the trough, because that's what makes it the peak. That's what makes it the trough. If they weren't the most over-optimistic, it wouldn't be the peak. And so I guess my question to you is, do you see that point as being a deeper critique of subjective expectation formation? Or is that just, again, in my view, just sort of the tautological process of how peaks and troughs have to be formed?
Yeah, it's a very understandable, it's a nice point. It is not a tautology. And so put yourself into my shoes or many others. Basically, if you are an academic believing in rational markets, then what you said doesn't follow. You basically, as you assume rationality, then if you see high valuations in 2000, it must mean that investors somehow they see low risk, or more likely there are such good times that there is low risk aversion, high risk tolerance, and people are demanding very low equity premium. So it's coming from that part as opposed to those growth expectations. And it's not coming from growth expectations because we are assuming rationality, and we know that turned out pretty badly, those optimistic growth expectations in 2000. So that type of logic is there. So there's always, when we see high valuations or more generally predictable returns, there can be a rational risk-based story or irrational behavioral story. And academics have debated this for basically your lifetime, not quite mine. And this is not just in market direction, it's again in stock selection as well, growth versus value and so on. Names like Pharma, French, Cochrane, Campbell are on one side of this, and Summers, Schleifer, Schiller, Thaler on the other side when we talk of the big names. And it was important to basically go to that survey data then to help adjudicate this kind of debate. And again, some people would say that, well, we just don't care about that survey data. We don't trust that people put their money where their mouth is. But there's more and more evidence that people do put their money where their mouth is. And so once that type of objection is, it has been very relevant to see that those expectations reveal that there wasn't rational behavior, low required returns in 2000. There was abundant bullishness at that time, which was hard to call rational, and it turned out exposed like a very bad prediction for the next decade. So overall survey evidence has, I think, then helped argue against this rational expectation story. And then it follows what you said. Causality goes from irrational over-optimism to high valuations. And that's good. But again, it's a tautology because there was always this opposite story that was posed in academic debates.
I want to talk about CAPE and its inverse, the cyclically adjusted earnings yield, because so much of your research and what you write centers around this measure, whether we're looking at it as time series data or cross-sectionally. And CAPE has been the focus of some pretty serious critiques, many of which you address in the later papers that I read. CAPE potentially ignores the impact of buybacks that have been so prevalent since the 80s. It ignores sector and industry changes that have happened, significant holdings turnover, structural changes in market access, or development in the economics of a country, or costs, overlapping window data issues. And so we can address all those points, but I guess my question is, maybe you can simply take a step back and say, despite these critiques, why do you still see it as a useful anchor for this analysis?
Because it is the benchmark, because it's the most popular series. Like, when I was really PhD student, CAPE hasn't been born yet, and people were looking at dividend yields as the market timing indicator. And then they figured that buybacks really changed that story. And so CAPE became the most important. And I would say that it's still the benchmark. And I do cover in part 6, I think, then all kinds of arguments, how it could be improved. And I think there are many possible changes that can be made, but they don't really change too much the real bottom line. So again, you can do better, but you may overfit those improvements. So I sort of like to use that as the base case and then talk around it, because it is still the standard in this space. I'll use this opportunity to say that among practitioners, I think the most maybe discussed or appreciated predictor that has done better as a return predictor than CAPE is something that was published in Jesse Livermore's blog 12, 13 years ago. And that's it's not his own name, but anyway, it's a good piece. It's basically equity share in a broader portfolio. And its predictive fit does look better. Actually, it looks sort of suspiciously good than CAPE does. And I do wonder a little whether there's some overfitting. But the basic idea is that it doesn't only look at the absolute valuations of equities. It looks at relative valuations versus other asset classes, which is helpful. And it even brings in somehow relative issuance, which can bring something extra. And I probably should have cited it. It turns out that I cited basically a very similar indicator by a fellow Finn, Paul Rintamäki, because I thought, okay, because he's a fellow Finn, but also because it was a more thorough study. I think I should have mentioned Jesse Livermore there. So, but to your bottom line question, there are improvements to CAPE, but I don't think any of them is a game changer. So I think it's fine to focus on that's the central metric that I use.
It's a great blog reference, by the way, for the listeners who maybe weren't reading investment blogs back in the mid-2010s. I believe it was called Philosophical Economics by Jesse Livermore. Really fantastic blog posts, and you can still find him on Twitter, so definitely worth looking up. I want to stay on the CAPE issue and press you a little bit here. Maybe you can help defend some of these critiques, right? Because when we are talking about looking at what are quote unquote objectively created capital market assumptions, looking at something like CAPE as a measure of valuation change over time, with all these potential issues, right? These structural changes that can occur in markets, the impact of buybacks, profit expansion, all that sort of stuff. You could, if you weren't aware of them, mistake high valuations or valuation expansion, right, as something that should mean revert versus a structural shift. And you could see the same thing when you're measuring cross-sectionally. Maybe you can talk a little bit in defense of CAPE, not just as being the standard that everyone goes towards, but maybe why some of these issues aren't as big an impact or how they're not impactful for the research that you're doing.
Yeah. And let me first just spell out sort of that criticism even more clearly, because it is one aspect of this is that earnings growth has picked pace. It has become faster, almost continuously in the last 200 years. Continuously is way too strong. But there's been this tendency. It used to be very, very modest, and now it's been quite fast in recent decades, especially then in US. And it's one reason why we have seen average CAPE of S&P 500 go from something like 15 before 1990 to averaging 25, 30 in this century. And this is a problem then for somebody who uses CAPE as a market timing indicator, because you are pretty much sort of expecting somehow CAPE to come back to some historical level. It just did not happen, maybe for a moment in 2008. But so overall, this richening is something which we know with hindsight, and that makes CAPE worse. And by the way, one reason why this Jesse Livermore's indicator is better, it's that it's looking at relative valuation. So when all assets were richening at the same time in 1980s, 90s, it's not a problem for that measure as it is for just looking at CAPE. Okay, so that's something. But so basically, CAPE gave two bearish average equity allocations for somebody who was sort of anchored to this very long run history. And that's why nowadays, by the way, people often show histories only starting from 1988 or so on, ignoring conveniently those. I call them out in my paper in a polite way. That's a pretty good trick to use. So that's a criticism towards CAPE. But even over this period, in recent decades, CAPE has been useful in more cyclical extremes, like with the 2000 peak and 2009 low. So it would have been useful. The real problem has been missing this structural gradual change, but it has been cyclically better. And it has been better when we get to relative performance predictions, partly like stocks versus bonds or US versus non-US and so on. But part of your question was about this faster growth. And I think I just want to get to that higher EPS growth rate. What really matters is whether we expect that to be there in the future. And I think like partly the problem with CAPE has been that it sort of gets overexcited when also analysts are overexcited. But there is also a plausible story to say that maybe we have really moved to this 3-4% type of real EPS growth environment from historical 2%, 1.5%, 2%, which was sort of the standard up to 1990, 2000 or so. And there's one very relevant paper, I think, on this by Fed researcher Michael Smolyansky, who looks at 30-ish years of data from 80s to 2020 or something like that, where he shows that real earnings per share growth indeed was 3-4%, roughly double what it had been in the past. But then he says that he can explain all of that excess, the trends of corporate tax rates going to very low levels and bond yields going to very low levels. Those mechanically have got a positive impact on EPS growth. And he says that if we shouldn't extrapolate these series which are already at very low levels in current times, if we don't think that that's going to continue, then we should rather expect for the future that good old 2% as opposed to that 4% that was due to those things. So I'm happy to stick with this roughly 2% real EPS growth prediction. But I acknowledge that apart from what Smolyansky says, there could be other things. And that most obvious other thing is AI. And so that could be such a game changer. And it could be that we'll get another decade of extra fast EPS growth, maybe even more than we've had so far. I was sorry to see economists talk about double-digit GDP growth for a while. Sounds more like Cathy Woods there. And so, but anyway, so those ideas are out there. But I would say it's a huge unknown, and ultimately it's a huge discretionary bet. And maybe I do say as an aside, I'm just so grateful that in our business, this is not so important. For so many managers, the active bet on where are we in AI, and maybe the sister question, what about Mag 7 versus the rest? That's just so relevant on your performance. But if you are a systematic manager with very diversified long and short positions, which are beta neutral and importantly industry neutral, that you don't have the big tech, you can make money or lose money, but so far so good for us in this decade, without being dependent on getting right the Mag 7 question or AI question. And so again, it is so important, but it's so unknowable, I guess, what's going to happen with that AI question in the next few years, that I'd hate to, bet the firm on that bet.
I want to stick with this theme of growth extrapolation or growth expectations, because when we look at historical decompositions of equity returns, it's really valuation change that tends to dominate on that decade-long horizon, right? You can talk about that yield component, that earnings growth component, but that valuation component is where most of the variance lives. Do you think this implies that investors are systematically over extrapolating growth into that valuation term. And that really what matters from an objective, rational perspective is mean reversion in that valuation component. Like that's the real story of what matters for getting these capital market assumptions correct, more than, say, those core yield and growth terms.
Yes, so then we are very humble. We don't assume that we can predict those valuation changes. So I think apart from the forward-looking estimates, I think it is helpful really to try to understand history, because that's going to tell us a bit more what's feasible. And actually, first, I want to just praise my co-author, Tom Maloney. He does lots of good things. But one beautiful thing he did in this series, he introduced a chart type, which we are using in some key places, I think very usefully. So it's so common to look at cumulative returns or rolling returns in a sort of go-forward basis. But what we do here sometime to address this average return and decomposition analysis, backward expanding analysis, and that's a mouthful, but it just means that we know that the latest data point is what we are interested in, what's happened until now, but we don't know whether we are interested in the last 10 years, last 25, last 50 years. Well, we can basically show evidence, and we do show with those pictures, the average returns and decompositions for any possible starting point. And I think that's beautiful because people can look at what's relevant for me, but also then sort of figure out how much the results change, how robust the findings are in looking at the last 10 or 25 or 50 years or so. So I think that's helpful when we do this analysis. And the lessons now to your question is that when we are doing the decomposition of yield and growth and valuation change, it's pretty clear. Again, the yield is the most useful prediction. And if we have had fast, high returns from valuation increases, or actually from abnormal growth is not much better than valuation increase, because both of those have tended to revert historically. There is some positive growth number, but when you get more of that, well, actually next 5-10 years, you should probably expect less rather than more. And this is not what humans do. But anyway, so that's sort of the overall result we get from such historical analysis. And now in a forward-looking sense, it is bad news for prospective returns that the strong past performance that we have gotten has mainly come from those reversible things, valuation increases and abnormal growth. And if anything, of course, the yield component is below average. So again, when I'm looking back, I do feel humbled about the fact that we, like many others, have then been wrong on let's say, US equities. But on a forward-looking sense, I feel more confident about being cautious here. One expression I use in the book sometimes is that we can think here of this, the rear view mirror thinking is a bit like Daniel Kahneman's fast thinking that just comes to us very intuitively. And then slow thinking is something where we have to think harder. And the slow thinking often points the other way to these forward-looking opposite messages and the decompositions, which sort of, when you look at them, they don't tell you to extrapolate from the last 5 to 10 years.
If we take valuation-based capital market assumptions and we give them the benefit of the doubt that they are developed in an objectively feasible and rational manner, and we plug them into a constrained mean variance optimization, we usually end up with a portfolio that looks absolutely nothing like any institutional policy portfolio that you've ever looked at. I actually used to run, as a side project, a website called theweirdportfolio.com, where I took, I won't mention the name, but it was a very large, sophisticated institution, and I would take their capital market assumptions that they published every year, and I would say, I'm just not even going to put the weird asset classes in here. I'm just going to use the stocks and bonds, and I'll target the same variance as a 60-40 using their correlation matrix and covariance matrix to come up with the 60-40 volatility profile. And the result was just so wildly different than something that any institution would feasibly hold. And so this is something you mentioned earlier in the conversation, but how do you reconcile this disconnect that these are, in theory, the objectively feasible market expected returns, and yet the implied portfolio is something that nobody actually holds?
Yeah. You mentioned that there could be some interesting alternatives that we leave out, which are, I think, more related to investor constraints and so on. But overall, I do think that I know from data that institutions on paper with their CMAs and so on, they look more the contrarian objective than retail investors do, which are much more extrapolative. But then, like you say, their actual portfolios don't follow quite this. And good case in point is the US versus non-US. Like again, any yield-based or valuation-based estimate would tell for the last 15 years that you should be underweighting US, and many institutions didn't, and they feel very, very good about it. So I think there is this broader thing that institutions do like to think of themselves as, when they look in the mirror, they see a patient contrarian investor. And then when they actually act with their portfolios, there's not always the patience and there isn't the contrarian. And sometimes it works in their benefit. And in the last decade, certainly with the US equities, it's been good not to be contrarian. But I do think that that's a broader point that, I don't know, the pro-cyclic tendencies of extrapolating, their temptations, they also happen at institutional levels. And I think that's probably the most important explanation.
Do valuation-based capital market assumptions contradict the efficient market hypothesis? In other words, is including valuations in a capital market assumption just a pseudo-sophisticated form of market timing?
Yeah, I think it's fair. I wouldn't call it too sophisticated because you are only looking at sort of 10-year horizons, which means that you only care about yields and valuations. You ignore short-term market timing signals, momentum, economic trends, sentiment flow indicators, etc. And so it's certainly the best possible thing to use for market timing. And then we do know that the record is spotty. We've talked often now about this fact that it really did badly with US equities in the last 10 years. But again, taking longer history, it is better than coin flip. It's better than rear view mirror. It's a choice whether we take that overall evidence as positive. But I think it is fair to think of it as some kind of market timing.
If we give the benefit of the doubt to valuation-based capital market assumptions that they are truly rationally objective, what do markets look like if we take it to the extreme and say that every investor behaved rationally and used them to form their portfolio? Is this a case where mispricings vanish, or is dispersion among returns ultimately still inevitable?
Yeah, this is a bit inside baseball here, but I remind that there's always a risk story here, and the risk story could be that we are in GFC 2009. Everybody's getting in this environment more risk averse. We are all demanding higher required returns for our risky asset portfolios, and yet we can't all rush to the exit at the same time. So that would be a situation where everybody would have common expectations, and yet we couldn't all act in the same way, because for every buyer, there needs to be a seller. And like one logical idea would be maybe that situation that some investors, typically you can think of long horizon institutions, they could be sort of the contrarian market timers and take more risk in that situation. That was sort of the idea and those more dynamically risk-averse investors would be basically selling at the bottom then at that time. But the broad point here is that it's feasible to think that we would all have the same expectations, but we can't have all same activities for every buyer. That's a seller. That's who is on the other side story that we talked about in 2010 in one conference, as you recall.
One of the claims that I thought was the most interesting of the series as I've read it to date, recognizing there's more papers to come, but was this idea that equity investors extrapolate while bond investors tend to expect mean reversion. And you suggest this idea of salience as being the driver behind this difference. I was hoping you could unpack this concept and why it creates such a stark difference in the expectations of equity and bond investors.
Yeah. So let's step back for a moment to clarify that evidence. So we've already talked about this point that equity, at least retail equity investors and equity analysts have got these extrapolative expectations. After good times, they get even more bullish on returns or growth or so on. Whereas when we look at rates investors, we see pretty much the opposite, that if we get a decade where yields are falling to all-time low levels, like think of 2010s, well, the normal behavior by rates investors is to expect some normalization. So you have got basically upward sloping curve, which seems to be a case of mean reverting rate expectations. And then when we think of what happened in 22, once rates went to higher levels, we got inversion pretty automatically. And again, I think it's best understood not as some term premium story, but mean reverting rate expectations. People roughly look at last 10-year average yields and think that we are going to go back towards that. And that actually, like I show, that's going to come in a future piece. I show quite nice pattern or co-movement between yield curve shape and just detrended short rate level, which is consistent with this mean reverting rate expectation. So it seems, again, data suggests this what I claim, extrapolative equity investors, contrarian bond investors, rates investors in particular. I don't know about credits, somewhere halfway. And this is, by the way, true both for market forwards and economist consensus and so on. Anyway, so the next question is why? And I'll get to that salience, but the first thing we looked at was that, okay, could this be just that this makes sense because historically that's what we have seen. We tend to see extra growth series tend to have continuation tendencies and bond series tend to have multi-year reversal tendencies. But actually, historical evidence is pretty much the opposite. So I can't say that this is somehow a rational reaction to what has happened in each asset class. So then I go to my intuitive idea, which is this salient story. And the salient story is quite simple. Just saying that, well, I'm an old bond guy, and so I certainly think about the world much more through the lens of yields. We quote yields, and that has made it more natural for me to think also about equities in a forward-looking sense. Whereas most people who come to equities, they quote them in prices, and they talk about last year's or last few years' performance of any equity-type investment, and that naturally gives this type of extrapolative mindset to them rather than the forward-looking contrarian mindset that bond investors bring to the table. So I do think that it really goes back to this kind of simple things of how we are quoting things, how we are talking about those markets, and it has got surprisingly deep impact then on market behavior.
You also note that experts and markets exhibited mean reverting rate expectations that looked foolish ex post during this really long bond bull market we had, particularly in the United States over the last 30, 40 years. And my question is, why do you argue that this was actually rational ex ante despite them getting it wrong for 30, 40 years, right? At a certain point, do you say, okay, you're forgiven for getting it wrong for 10 years, but maybe you should be updating your models. Maybe your ex ante model is just completely incorrect for the regime. How long can you continue to say that someone is acting rationally and yet be continuously on the wrong side of the forecast?
Yeah. I had this intuition in both of my books, and it's nice that some recent academic studies have formalized the intuition that I have. And it is that learning about gradual structural changes or these very persistent movements, it is really hard. And if something like what we saw with yields, let's say inflation going up 30 years and then falling 40 years, and the real yields coming down for a long time, or again, the Cape trends that we see, those really trip us easily. And when those things happen, we get the hindsight that this really should have been foreseeable. But at any point in time, we are hitting some new all-time lows, and I'm predicting that we are going to go into even further lows. It certainly wouldn't be consistent with sort of the historical evidence where we are already at all-time lows, and there has been some mean reversion tendency in those series and so on. So I think I am very understanding and sympathetic to this type of logic. And then so some academic studies have shown that when they model a rational investor who faces evidence on what's been happening to either inflation or some real rate behavior in recent decades, they said, well, mean reverting expectations has been the rational thing to do all the time, but it just turned out wrong many times. You know, in bonds, 22 turned out fine, but it's sort of a small excuse when you take this longer history. And with equities, we really haven't gotten, in a long time, we haven't gotten this, due mean reversion in valuations that would happen. So I think this is a good descriptive story of what has happened in recent decades. And so it makes me think that while those equity analysts' behaviors, they really are irrational here, we can tell a very plausible, rational story, which should make us laugh a little less at the foolish errors. You know, we also showed these pictures of yields falling for 20 years and people expecting rising rates any point in time. And when will you ever learn or something like this? But again, with hindsight, this is something which we can explain pretty well. And the last point I want to just add here is that Now we were talking about the trend, but when we look at within trend, if you look at just monetary policy cycles within those trends, actually expectations were pretty good there. So you had basically, whenever you got this policy tightening, such as we had after 22, then you had basically inverted curve and expectations for falling rates. And when you had very, very low rates, very easy policy, you had tightening expectations. And those things tended to work out fine. The problem was with the trend keep going down, 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 which any forecaster consensus, maybe not every forecaster, but any consensus series or market series missed.
In equities, you note that investors tend to extrapolate U.S. exceptionalism, particularly around U.S. tech. And your paper that focused explicitly on U.S. versus non-U.S. equities showed that most of that, the edge between U.S. versus non-U.S. was actually valuation driven, not growth driven, even adjusting for these issues. Curious why you think investors persistently misattribute this. It's at least my anecdotal evidence or anecdotal realized conversations that people do think that it was U.S. growth that was the reason why U.S. outperformed international, and it wasn't a valuation story over the last decade.
Well, I think there is some human laziness because the numbers, again, do tell a somewhat different story. But the one excuse that there is that there truly has been some U.S. growth edge, even when we go back 50 or 100 plus years. So there's something like, let's say, 1% U.S. growth advantage has been there over the rest of the world. And you can see it even with very long run Dimson and his co-author series. And we can attribute it to U.S. exceptionalism from the entrepreneurial culture, better institutions, and so on. Or could be just luck that you didn't have war on own soil, hyperinflation, revolution, and so on. But anyway, let's give more credit to U.S. exceptionalism than luck. Now, post-GFC, we just got much more than that 1%. And people have been quickly willing to extrapolate that to the kingdom come or for whatever indefinite future. And that has led to those valuations to grow. And so then I would want to sort of throw some ice to the hot thoughts there by reminding, for example, that U.S. outperformance post-GFC has been there. But do people know that U.S. actually underperformed in 2000s, in 1980s, 1970s? There have been many decades where U.S. has underperformed. And if we take even this good period now where U.S. outperformed, I think it is good to remember the history. And I got some nice pictures of showing the relative pricing, so U.S. Cape versus non-U.S. Cape. And that versus next 10 years history, it has been really good predictor in 80s, 90s, 2000s, just not in the post-GFC data. So again, it is missing that one. But when we look at that history, it does tell that U.S. actually had half the valuation of the rest of the world in 1990 during the Nikkei bubble. And then we got to sort of parity valuation, similar valuation levels in 2000s. And more recently, US got to almost double valuations, which is sort of pretty much a mirror of the Nikkei bubble story. So the history says it is going to be very difficult to outperform from those levels because those types of valuation gaps embed some really extreme growth or persistent growth edge, much more than that 1% that's expected. And so I do think that people have focused too much on that recent evidence and extrapolated much too lightly. Always at any point in time, there will be stories, and I just talk about statistics here, but there are other stories of the Mag 7 and Tech Edge and now AI and so on, which support the stories. And so that's fair. But maybe I'll conclude this answer by saying I think I summarized it decently when I was talking about my battle regarding or against rear view mirror expectations. I say that the rear view mirror mindset is more pronounced when over-extrapolators recently got it right and become overconfident because of that. Also more pronounced when we talk of stocks rather than bonds. It's more misleading when past performance came mainly from valuation increase as opposed to something more sustainable. And we are now at historical extremes where mean reversion risk is greater. And they are more vulnerable when the rear view mirror is not very long run where it might be a good base case or just last year where momentum might work, but it's something like the last 3 to 10 years. That's a really dangerous rear view mirror. And then the last dangerous thing is when there's a catalyst, when the times are changing. And I think all of these features somehow fit pretty well to the story we have now in the US, non-US story, that I still am cautious in making any calls for the next few months. It looked good for a while, but again, short-term things will dominate for a while. But if I take a 3 to 5 year perspective, I feel exceptionally confident that this is not the time to overweight US.
In one of the latter papers of the series so far, you argued that required asset yields have reached potentially a natural lower bound. And I thought this was a really interesting claim. And so I was hoping you could sort of unpack what drives this claim and how, if that is true, how that impacts how investors should think about return expectations going forward.
Yeah. There's a multi-century picture of real yields, and this is real bond yields coming down. I'll first tell that, and then I say that there's actually another story which is about equity premium. But there was a paper, Paul Smeltzing's paper a few years ago, and then it was combined with Ken Rogoff and Barbara Rossi, I think, in a later study, where they basically showed that starting from Middle Ages, when real bond yields were like 10% or more, we got this nice trend towards zero and recently even to negative real yields, as we saw now a few years ago. And that trend sort of suggested, hey, maybe we can go to minus 5% or something. And in the new paper, the authors did say, well, it's a very loose trend when we talk about hundreds of years, but also there might be something happening at the zero level, which makes it less likely we are going to hit minus 5 and minus 10 down the road. And I think it's maybe intuitively it's good to think about with nominal yields, a zero lower bound, which again, we did see a few years ago that it wasn't quite so tight as we thought. It was porous, but nominal yields didn't really fall more than to minus 1% or so on. And then if inflation expectations are not too high, it's hard to see much more than minus 2, minus 3% real yields. So if we are getting to the kind of real yields where we were a couple of years ago, it's much harder to argue that there is still a trend downwards than mean reversion tendency upwards. So that was the natural lower bound story when it comes to real bond yields. And so since then we have had, of course, this shift. 10-year TIPS yield has gone from minus 1 to plus 2%. And just as an aside, one of my pet peeves is this question that how come so many supposedly real long-term assets don't care when 10-year TIPS yield goes from minus 1 to plus 2%? How come real estate, public equity, private equity hasn't been repriced given such a change in the relevant part of their discount rate? Anyway, but another example of this natural lower bound is, of course, then equity bond premium. And I think there is some intuition that it should always be positive, and it certainly was coming down in much of the 1900s. And with many metrics, it sort of got to all-time lows around 99, 2000, because you had the highest CAPE then, and actually treasury yields were like 4% real or something like that. So negative equity bond premium. And that didn't last long. And since then, we got some higher numbers. But since 22, we were getting again this compression of equity bond premium. Basically, bond yields rose and equity valuations hardly changed. So we are not in 99, 2000 type of situation, but we are, from historical perspective, in particularly low level of equity bond premium. And I do think that from these levels, it's really hard to go to these negative levels, although I can also see a very bullish euphoric market out there where it could happen for a while, but I do think it's not going to be a sustainable situation if we get that type of market in the next year or two.
Well, I feel like I have to ask the follow-up question. You left it hanging there a little. I'm curious, do you have any fundamental views as to why certain assets haven't repriced with a 300 bip increase in real rates? Is it just, again, over-enthusiasm, over-optimism, or is there actually a fundamental story there?
There's a different answer, I think, for privates and publics. For privates, they really don't want to reprice, and they've been able to get away with it so far. And basically with relatively frozen markets, there's not much volume when there are some unrealistic valuations out there. That's the private side. But on public side, I do think that the AI story has been a savior here, and clearly it's fundamental. And whether it's in bubble territory, that's again, it's a big question. Like I sort of tend to say that I don't know whether we are in the 5th inning or 9th inning on that one, or soccer-wise, halftime or overtime on that one. And nobody really can know that. We'll see. But if I'd have to guess, I think we'll be closer to the overtime part. And that comes not just looking at things like valuations and so on, but basically the young investors' risk-loving behavior with obviously meme stocks, but zero levered this and that, levered Bitcoin, levered single stocks, zero. Oh, anyway, so there's so many things that somehow reveal that there is not much respect for risk. And again, that's going to help short term, but eventually I think it's showing some problems that we're going to be seeing in the coming years.
I think a skeptical reader of your series would look at some of the data you provide and say, this time series goes back 150 years. Why is that even relevant to forming a rational, forward-looking analysis today? What does a market, even staying in the same geography, what is the U.S. market 150 years ago when it was an emerging market with a totally different composition, totally different risk profile, totally different means of accessing capital markets? How does that help inform my decision making today? And so my question to you is, how do you justify using sort of centuries of data to inform these expectations that we're trying to create for the next decade?
Yeah. So I would say zooming out is a virtue. And before this series, my previous study was actually with Elroy Dimson and 2 other co-authors studying pretty much data before a century ago. So really going back to 1800s, if we could, and look at asset class behavior and so on. And you may have seen the result by Edward McQuarrie that actually 1800s equity bond premium was near zero. And I think, well, that's interesting and certainly raises follow-up questions. But among the follow-up questions are the ones that were implicit in your skeptical point that, yes, we know world has changed. We know data quality is worse. Should we care at all about this stuff? I do think that we should not totally ignore it. I think it's right to give more weight to more recent data, but it's just so typical for today's investors to only care about that one experience where their own life memories are, and maybe a little longer to GFC or something like that. But I do think there is some information in those longer histories. So especially when we are talking about CMAs or something where we're talking about 5 to 10 year expected return, so long horizon, then studying just one 10-year period. It's a joke or it's a misunderstanding. It is really one observation that you are looking at, or sometimes it's half an observation that you are looking at. So even when we look at last century, that would give us 10 independent observations. And the fact that if you go to monthly data, you get some overlapping extra, it doesn't give you too much more. I mentioned it somewhere there that it might give you from 1 to 1.4 or something like that, but it really doesn't give you 10 times or 100 times more information. And maybe another cute answer to this type of question on 1800s or so. Yes, the institutions have changed, environment has changed, but human behavior hasn't changed. So there is something interesting that we can get from those past times, which might be timeless. So overall, I do think that it's right to focus more on more recent data, but ignoring things beyond last 30 years or so, because the world was so different, I think that's a bad idea.
I want to tie this into the practical as we get towards the end here. And it's one thing to come up with capital market assumptions from a purely research interest. It's another thing to actually implement them. And so from your perspective, when investors use long-term capital market assumptions, call it 5 years, call it 10 years, and they're using them to set the strategic portfolios, how often should they realistically be re-optimizing those portfolios or rebuilding those portfolios as informed by the capital market assumptions? And here the question comes from, at least in my view, the fact that there's such a large overlap in the assumptions from year to year, right? If we're using 10-year forecasts and we're rebalancing once a year, it's 9 years of overlap. And you have these fairly wide forecast confidence intervals. And so to me, the question becomes, what is the practical cadence here of not overfitting noise from one update to the next?
Yeah. I think it makes sense to track these things, certainly at least on an annual basis, but to make some, well, again, depends. If you're a contrarian investor and you want to somehow try to use this, then you may want to take actionable measures then even every 6 months or 12 months and so on. But I think for many, it's fine to do this only every few years. So because these are meant to be more like planning tools as opposed to market timing tools. If you want to do market timing, I think you want to bring in some more short-term indicators beyond the things that are in capital market assumptions. And then to your, it's fair to say that, again, last 10 years sucked. And when you look at longer histories, there are quite wide or large forecast errors, or in a forward-looking sense, wide confidence intervals. So I am trying to balance the humility and realism, which is related to the fact that, there's not too much information, but I also want to go against the nihilistic mindset that, hey, there is no predictability, and then you could just as well ignore starting yields, and you could say that you can use the rear view mirror because why not? And I'm saying data doesn't support that type of nihilism. That data says there is some useful information in those starting yields and valuations. Let's use that at least as a planning tool and may consider having some contrarian tilts then based on them. And they are inherently then slower moving and 1 to 3 year type of things where they really start to matter in the portfolio.
How does AQR itself tackle these challenges, balancing valuation anchors, structural changes that can occur over time, the behavioral pitfalls in coming up with these measures when forming the capital market assumptions that you publish? And I believe you publish them annually. How do you try to avoid all these traps that you've highlighted in the papers?
Yeah. So as a starting point, I'm going to focus on 5 to 10 year estimates where yield-based estimates are especially important. When you go to even longer horizons, those starting yields even don't matter much. And then you might want to just think of some decent intuition like 0.3 Sharpe ratio for most asset classes times the relevant volatility or something more theory-based. But if you do this yield-based approach, which we do whenever we can, and by the way, we cannot maybe with hedge funds or commodities or so on, it doesn't make sense. But in most asset classes, we can do that. So then we say that, okay, let's use something like discounted cash flow model, yield plus growth for equity type of investments. And we try to be thoughtful about those inputs. We try to bring in things like net buyback yields and so equities and roll down effects for bonds. And so thoughtfulness. Another thing where we want to be thoughtful is with that growth, but I think you don't want to let that vary too much over time or across countries because there is so limited forecastability. I think there's some forecastability and you want to try to capture that. But if you do more than plus minus 1% around an anchor, I think you are probably too overconfident or aggressive. We just don't have enough information on that. So I'm sort of anchoring those growth estimates quite a bit. And certainly excluding, by the way, those analysts' growth forecasts, which again logically would make a lot of sense to use them, but because the evidence is so clear that their over-extrapolation makes them inverse predictors of future growth or future market returns, you don't want to include. Then in addition to this, we do model averaging. We don't know what's the right model, so let's combine a couple of or different types of inputs there. That's something. And then especially on the mean reversal question. So historical data would suggest for real bond yields, there seems to be some mean reversion. Equity valuations and maybe margin growth or something like we could find some series which have exhibited some long-run mean reversion. But they also have shown quite persistent trends and especially in recent decades. And so somehow we've chosen not to include that part there, saying that there may have been a structural change. And we are already getting the message of, let's say, high valuations will give us low starting yields. And that's sort of enough for us to get the contrarian spirit without adding the mean reversion, which would, double up the effect there. And so we are allowing this possibility of structural shifts to take away the mean reversion logic. And that's a really debatable thing. If there wasn't a communication simplicity argument, I would probably assume 10-20% mean reversion. So mild mean reversion in over a 5 to 10 year horizon, something like that. That would be the base case. I'm glad we didn't do that because last 10 years that would have made us even more bearish. And one of my lame jokes is when people tease us about our cautious US equity returns. Well, at least we didn't have the RAFI and GMO mean reversion assumption there.
One of the risks of publishing research and data in particular is that people might use it in a way you didn't intend, right? So you develop these capital market assumptions and you publish them to the world. If you were in the driver's seat for an allocator who is ingesting those capital market assumptions, what's your preferred way in which they'd be deployed to inform their actual allocations?
I think they should be somehow used, but with humility. So again, we do put some confidence bands there to highlight that these things can be quite wrong. So very aggressive actions based on them are, I think, always a bad idea. But tilting towards them and maybe using them to try to remain patient when we are in a situation like we have been, for example, with US, non-US. If these things help people stick with a view, which probably makes even more sense now than a few years ago, then that's helpful. But any very aggressive use, I think I'd be quite cautious. There just isn't enough predictability here.
So we scheduled this interview, I think months ago, around your very busy schedule, very busy travel schedule. And unfortunately, the series isn't over. I would have loved to have done this at the end of the series and gotten the full picture, but give me a preview. What is to come? What do you still have to explore in the rest of the series?
So we published 7 pieces with Tom, and we got, I think, 3 to go. Might be a 4th one. We'll see. So basically, there will be 2 on bond markets. One will drill into this yield curve story, mean reverting rate expectations. I think there's something more than just to highlight sort of the elevator pitch story that we've told in an earlier piece. But another one is just on bond yield levels. I think this is what I've written about for decades. It's my sort of favorite thing to think about, decomposing just 10-year yield with survey data. And you can basically think of 10-year yield as inflation expectations, roughly R star, real short rate expectations, and required term premium. And it's interesting to do that with survey data. And in recent years, the story is basically that we got this increase in bond yields from these very low levels because both real parts, R star and term premium, went from negative to positive, while inflation expectations didn't move almost at all. And I think this is highly topical now because clearly the inflation expectations stayed as well anchored a few years ago because of Fed's credibility. And right now, the administration is pretty much ready to play with fire there. And so I do think that there is a sort of, this is a discretionary view here now, but based on all that type of analysis and adding a bit of discretion, then we have a better chance than in many decades to see long-run inflation expectations getting de-anchored. And that would be a pretty serious issue for not just for bond markets, but for many other assets. Don't know whether that's going to happen, but again, the chances are bigger than even in my career lifetime. I wasn't active in 1970s. And so that's a bond part. And the very last piece that we are currently thinking is basically rear view mirror and liquid diversifiers. So that's getting close to also your home court there. And I think like investors clearly, last few years have been pretty good, but let's say they often think of just last 10 years, including then the bad times in 2010s for some liquid strategies, could be commodities, could be value, could be trend, and they are not so forgiving on that one compared to especially much longer histories, which I think are more relevant. So I think the rear view mirror has been discouraging investor adoption of liquid diversifiers, whereas investors have been obviously embracing illiquid alternatives. And there, I think the rear view mirror, one can even debate the data, but certainly when you look at why they would have had as good performance, thinking of, for example, private equity, there were basically conditions of much wider valuation band, much cheaper leverage than what are available now. So I do think that it's very difficult for, let's say, private equity now to deliver any kind of outperformance as long as we have got the valuations where they are now and leverage, cost of leverage where it is now. And fee level is another one. If they were to lower the fees meaningfully, that would be another way of solving the expected return problem. But our estimates say that historically, great performance for privates, prospectively, pretty gloomy near term, and eventually things can change, but it will require changes in either fees or rate level or valuations in those privates. So anyway, so those are still in the pipeline and then probably over unless we decide to do one last concluding piece, and that's to be seen.
Well, Antti, while I have you, I'd be remiss if I didn't ask a question about one of the papers that I consider to be one of the seminal papers ever written on stocks and bonds, which is a paper you wrote back in probably pre-2003. I know it was published in 2003. Knowing the journal process, he probably wrote it in 2002. But it's the appropriately titled Stock Bond Correlations. And this is a paper that I must have sent to dozens and dozens of people in 2022 when stock bond correlations were spiking. And this was an unusual experience for them. And they were looking for more fundamental arguments and explanations. What I wanted to ask you about that paper, and really it's not about that paper specifically, but that's a paper that was written 20 plus years ago, whose relevancy really heightened 20 years later, and I think proved correct in its fundamental arguments. But my question is there anything about that paper that if you were to rewrite it today, lessons learned or maybe ideas changed or novel thinking that you would like to add or clarify to that paper?
Yeah, we did write another paper just a few years, maybe 22, 23, then with several colleagues. Like Jordan Brooks had already a nice idea in 2010s, and then we put all of that together. This is maybe JOPM paper, Brixton and all, 5 or 6 of us in that paper. So in the original paper, there were many points why the stock-bond correlation might flip side. And by the way, I do feel pretty proud that I was sort of seeing it happening maybe like 98 LTCM time. I was starting to think, is this going to turn from positive to negative? And I think I sort of got that pretty well. And then greedily have been thinking whether we can get the other part flipping positive. If we'd have to pick one story out of the few things that I was highlighting there, it was sort of level-dependent inflation uncertainty, which could be just then said that at higher inflation levels, there's more stock-bond correlation. But I think this Jordan's toy model turned out to be really useful to say that let's just think of stocks and bonds being driven by growth and inflation news. And if you have got growth-related uncertainty, which tends to push two assets to opposite directions, then we have got negative stock-bond correlation. If you have more inflation-related uncertainty, which tends to push both assets to the same direction, we have got more positive stock-bond correlation. Well, that storyline tells very nicely why in late 1900s we had a positive stock-bond correlation, and once inflation expectations stabilized around 2000, there was only growth uncertainty and 20 years of negative stock-bond correlation because growth uncertainty dominated. And so with that story, it's been the case now for the last few years that the sign of stock-bond correlation is going to be primarily driven by, do we get this de-anchoring of inflation expectations? And we get a sense of that in 22, but not so much. So we are sort of hovering nowadays near that zero. And again, I feel very confident then in saying that the future of that stock-bond correlation is primarily going to be driven by what happens to those inflation expectations. Not really the level, but related to that level comes the inflation uncertainty. And this uncertainty would, I think, push stock-bond correlation then to positive levels. If markets in their complacency are right, and we just go to 2% humdrum type of inflation, stable inflation world, then we probably will have still negative stock-bond correlation in the future. So I think I'm quite happy with that second paper clarifying the mechanism, and that it's not just inflation level, but it's really inflation uncertainty versus growth uncertainty. Plus, we do cover several other things. It matters whether growth and inflation are positively or negatively correlated. You can think about the role of credit risk. All of this sort of presumes that we are talking really of riskless government bonds, whereas if we are talking of Greece sometime or some emerging markets where they have got lots of credit risk, it's a very different story. That's getting interesting now when the government deficits even in US have raised some alarm bells, and that could be another logic that could push stock-bond correlation higher. But anyway, those are sort of the side stories. The big story is about those inflation uncertainty.
All right, Antti, we have come to the end of the episode here, and I want to ask you the question that I asked every guest for this season, which is, what is something outside of work that you are currently obsessed with? It could be an idea, an experience, a hobby, something that has really captured your attention. And I know your default would be to say expected returns. You cannot say expected returns, but something outside the realm of work that has you obsessed.
I have cared about balancing work and life, and I'm pretty happy with how I've done it with family and with friends and paying attention to such things for decades, because it does pay off. It really, like, this comes from a 60-plus-year-old guy. And also with your situation with the youngs, well, you better focus on those, but try to keep some other things in mind. And now specifically then, I'm originally from Finland, and I've always had my connection. I've got lots of friends from that time, and I don't know, the roots are calling stronger for me. I want to spend more time there, partly because I love the country, the nature and so on, but I also have lots of family and friends there, which is just wonderful. And so recommending playing to such softy types of thoughts also for others.
Antti, always a pleasure. Thank you so much for joining me.
This was great.